The US national debt just crossed $40 trillion for the first time ever. That sounds like an unbelievable number, but here is the bigger question. What does $40 trillion of US debt mean for stocks? Let's break it down. The latest Treasury data puts total US debt above $40 trillion. Around $32.3 trillion is held by the public, another $7.8 trillion is intragovernmental debt. But the bigger concern isn't just the debt size, it is the cost of carrying that debt. The US government pays interest on its outstanding debt, and those interest costs are getting much larger. CBO projects net interest costs will rise from about $970 billion in 2025 to over $1 trillion in 2026. By 2036, CBO projects that figure could reach about $2.1 trillion. So, where do stocks come into this? One major connection is Treasury yields. Treasury bonds compete with stocks for investor capital. When Treasury yields rise, stocks can face challenges in valuations and investor demand. Higher yields can also increase borrowing costs that can affect companies, consumers, and the broader economy. There is another important effect. Higher interest rates can change how investors value future earnings. This matters especially for growth stocks. Why? Because much of their expected value can come from future earnings. Higher discount rates can affect how investors value those future earnings. But here's the important part. $40 trillion of debt does not automatically mean stocks will fall. Markets are much more complicated than that. Economic growth matters, inflation matters, Fed policy matters, corporate earnings matter, and treasury demand matters too. Right now, the bond market is giving investors another signal. Long-term treasury yields have moved sharply higher. The 30-year treasury yield recently touched about 5.337% on August 18th. That was its highest level since 2007. It then fell to around 5.187% on August 19. Current market data puts the 30-year yield around 5.2% on August 20. The 10-year treasury yield has also remained elevated. That matters because treasury yields influence borrowing costs across financial markets. Now, there's another piece investors need to watch: the Federal Reserve. The Fed's federal funds target range is currently 3.5% to 3.75%, and investors continue watching inflation and future rate decisions closely. So, there are two major forces to watch. The government needs to finance a huge and growing debt load. At the same time, the Fed is managing inflation and interest rates. That makes the treasury market extremely important. There's also an interesting development from the Treasury. The government has expanded its buyback operations for longer term Treasury securities. The goal is to improve liquidity and support Treasury market functioning. The Treasury plans to increase the size of these operations from $2 billion to at least $4 billion per operation starting September 9. But the bigger issue is still fiscal policy. CBO projects debt held by the public could reach around 120% of GDP by 2036. That's the number investors should really watch. Not just the $40 trillion headline, but the debt trajectory. For stock investors, the key question is not simply whether US debt keeps rising. It is how debt, treasury yields, Fed policy, and economic growth interact over time. So, what should stock market investors monitor? Three things. First, treasury yields. Second, federal interest costs. And third, future budget deficits. These can influence financial conditions and investor sentiment, but they don't tell us exactly where stocks will go. That's an important distinction. The $40 trillion milestone is not a prediction. It's a reason to keep watching the bigger picture. US debt, Treasury yields, interest costs, inflation, and Federal Reserve policy. Together, these factors can influence stocks, bonds, currencies, and commodities. So, the real question isn't, will $40 trillion crash the stock market? The better question is, how could rising debt costs affect financial conditions over time? That's the story investors should keep watching. And that's what we will continue tracking here. We will follow the data, we will explain the market impact, and we will keep breaking down major developments without the unnecessary noise. If you found this video useful, please like and share the video. And for more simple, data-driven explanations of major market developments, subscribe to the channel. Thanks for watching.